Wall Street Week with Louis Rukeyser. Brought to you by public television stations. And by Prudential-Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. Produced Friday, June 2. Guest host is Carter Randall. Our panelists are Elizabeth Dater, Robert Newrock, and Martin Zweig. Tonight's special guest is Gerald Perritt. Editor, Mutual Fund Letter.
Good evening. I'm Carter Randall. Louis Rukeyser is taking a night off, so I'll be your host tonight. Welcome. This was the week for purges, resignations, and all kinds of tough talk. Within the past several days, 2 powerful members of Congress resigned rather than face charges of ethical violations, including involvement with junk bonds. On Wall Street, Carl Icahn made a record-breaking sale, selling off in one day his entire stake in Texaco, and all that junk worth only about $2 billion, for a profit of about $600 million for his trouble. Mad money for old Carl. Our U.S. Trade Representative, Carla Hills, has been feeling the heat for getting tough with some of our closest allies over opening up their markets for our exports. How about exporting some excess stock market technicians? The Surgeon General, C. Everett Koop, has come out hard against drunk driving and alcohol consumption. So far, though, no derogatory remarks about the 3-martini lunch. So how did the market react to all of this rough stuff? Rather well, in fact, and there was good news from all of the economic figures released this week. The index of leading economic indicators snapped a 2-month downturn with a broad show of strength. Construction spending also stopped a 3-month skid, inching up 0.1%. After 2 months of decline, new home sales had their largest monthly increase in over a year. The employment picture also looks good, with the unemployment rate dropping this month to 5.1%. But not everyone thinks the future looks rosy. The Organization for Economic Cooperation and Development revised its forecast for the U.S. inflation rate to 5% this year and 5.25% next. And bad weather was good news, as rain in the Farm Belt presages an end to the long drought. But bad news for grain futures, which sank to their lowest level in 14 months. Later on, we'll be talking with a mutual fund expert. But first, let's take a look at the barometer from Wall Street this week. The Dow Jones Industrial Averages started the week on Tuesday with an 18-point loss. But over the next 2 sessions, they gained most of that back. Today's gain, the largest in 2 weeks, brought the average for the 3rd time since the 1987 crash to over 2,500, with a weekly gain of 24 points to a new post-crash high of 2517.83. The broader markets also had a banner week, as each one of the indexes showed stand at a post-crash record high. The only bearishness to be seen is with our elves. Despite all the good news, they remain dubious 16 weeks after their sell signal and are down to a notch of -3. Meanwhile, the New York Stock Exchange approved a new stock portfolio trading product that will allow institutional investors to buy and sell an entire basket of stocks in one transaction. A transaction that will only cost $5 million. Not much for the average investor. One other momentous event took place. The Southwest Bank of St. Louis reduced its prime rate. Citicorp, where are you? Marty Zweig, I've known you for a long time, and I know you as one of the great worriers of all time. You worry about everything.
Yes.
Now, the Federal Reserve is buying dollars worldwide. Interest rates are coming down. We're at a yearly high in the stock market. Are you still worried?
I'm not too worried, and that's probably terrible for the market. I worry when I don't worry. But you said something interesting about the dollar, and I think that's possibly one of the most bullish factors right now. The Fed, the government doesn't want the dollar to go up. Foreign governments don't want it to go up, and it's going up almost relentlessly. And I think that's very bullish for stocks and bonds because I think foreigners might just get itchy and follow the dollar into our markets and buy stocks and bonds.
Are we going to see interest rates going down?
If the dollar continues to go up, I think so. But I'm no expert on forecasting the direction of rates. But a stronger dollar would help rates because it would tend to be disinflationary. It would make it more difficult for us to export, and a stronger dollar might slow down our economy, which should force rates downward.
So in spite of this new high, you're still a buyer?
I've been a buyer, I'm ashamed to say, yes.
Okay. Bob Nurok, wherever I go, people want to know who the elves are. And I always use improper language, but I say it properly. The elves are Bob Nurok. Now, in February, the elves gave a major signal to sell.
Correct.
When are they going to get with it, Bob?
Well, I have to admit the elves are either very early or wrong. I mean, there's no doubt about that. In fact, I should thank a viewer who sent me a very interesting letter with a detailed statistical analysis of several of the indicators, and one of the indicators he's shown me has been distorted since the middle of last year. The elves are in the process of revising the TMI to make it more adaptable to some of the changes that have taken place in the marketplace, but obviously that does not eliminate the sell signal. I should say I have developed my own new indicator called ESP, the elves short-term predictor. Interestingly enough, that is at the point now on a short-term basis where it is saying any meaningful reversal to the downside for the market probably marks a significant top. So my view is still one of caution, and I've been suggesting that investors take money off the table as the market rallies.
Okay, so you're not chasing this market on the
I'm not
upside.
chasing it at this juncture. We're about 43% long, 42% in cash, and 15% short, a balanced position.
Wow, okay. Beth Dater, what's on your mind nowadays?
Well, Carter, I think that Marty outlined the fact that interest rates have probably peaked, and the market is saying that the inflation rate has probably topped out here, and so the consensus really seems to be looking for the soft landing, kind of very almost recession sort of scenario. I guess what my concern is, and I think that the thing that might trigger Bob's scenario, is that we may now start to worry about the recession will be deeper at some point later on this year. Will earnings be affected? I mean, earnings today are 40% higher than they were in the summer of 1987. That's not sustainable probably forever, and so people will start to take a look at that, I think, as time goes on. But generally, I'm quite positive about the market.
Are there any specific securities you'd be buying at the present time?
I really believe that even in a slow, slight recession, that growth will out here. And I really believe that the value in the market is in the growth area, large capitalization and small capitalization. In the large capitalization area, I like PepsiCo, Gannett, Warner Communications, McCaw Cellular, Corning Glass. In the small capitalization area, Zoma, Helene Curtis, Alberto Culver, A&W Brands, Century Communications.
And I might add, as we always do, no guarantees from the management. Right. Well, now that you've all answered all of my questions, let's see how you can do with questions from our viewers. Marty Zweig, Raymond Henderson of Houston, Texas, writes this as follows. Many annual reports these days contain an abundance of footnotes. Are these tools that some companies use to hide costs or to boost earnings and assets? And he also wonders if there is a simple way for the small investor to analyze these figures to find out if companies are hiding anything in their balance sheet.
I don't think there's any simple way. Accounting is pretty complicated, but you can read the footnotes, and the footnotes do disclose a lot. For example, there are a variety of ways you could treat depreciation or inventories, installment sales, pension treatments, and whatever. And a lot of that is revealed in the footnotes, and depending on which method of accounting the company chooses, earnings could be higher or lower vis-a-vis the other method. And it's important to look at that because earnings can be distorted by the different accounting treatments.
And I might add, in reading an annual report, it's important to read what they have to say, too, isn't it?
It's boring, but you should read it, yes.
Okay. Bob Nurok, Ronald Eaton of Sacramento, California, is a student majoring in finance. And he manages what he calls a hypothetical portfolio of 50 stocks with a current value of $20 million. He wonders how important it is to master some of the more esoteric technical aspects of stock evaluation. What do you think of that?
Well, I think a well-rounded investor will know both fundamental and technical analysis. I don't think either one stands on its own completely. And so I think anybody who is studying fundamental analysis should become familiar with the precepts of technical analysis, because as he's probably learning already, stock prices tend to anticipate or discount future or fundamental events in advance of stock prices. Sometimes can be a clue to whether your forecast is correct or incorrect.
Okay, so follow trends but not blindly.
That's correct.
Okay. Elizabeth Dater, Patricia Van Brook of McKinney, Texas, Lynn Buchanan of Camarillo, California, and some others, as a matter of fact, are interested in getting in on the ground floor in the new technology of high-definition television. Do you think this will become a real moneymaker in the future? And if so, what companies would you bet on to become the leaders?
Okay, Carter, I think high-definition television in the mass consumer market is 6 to 10 years away in the United States. It's really an enhancer in terms of design and quality of the picture, much like stereophonic sound was. However, in Europe and in Japan, where you have direct broadcast satellite, it's a viable technology today. The technology at this point is largely owned by the Japanese companies, the usual suspects, Sony, Hitachi, NEC, Toshiba. However, in the United States, there are niche market applications, particularly in the military. And I think you'll see some of the secondary contractors, such as Adams Russell, Avantech, Maycom, Secor, and some companies yet to emerge. There's a division of a company called Summa Medical that's really very progressive in this technology. And so I think you'll see some real emerging, small, very interesting companies. And so my advice is stay tuned.
Okay. Pretty good advice, I think. Now, if you've got a money question that you'd like one of our high-definition panelists to tune into, just transmit them in the low-tech U.S. mails to us here at Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Now, before we meet tonight's special guest, let's take a look at one of the small investors' most popular investments and meet our mutual friend, the mutual funds. The number of mutual funds to choose has been growing quickly. 9 years ago, there were just 564 funds. Today, there are 2,734. In fact, many more funds than there are stocks on the New York Stock Exchange. And how much money do these funds represent? The dollar value of mutual funds has also steadily increased. In fact, mutual fund assets are now at an all-time high of $882 billion. But dollar value does not tell us everything. The October crash of 1987 took a heavy toll on mutual fund sales. But things are looking up now. Early estimates for 1989 show an increase in sales, but still not back to the level seen before the crash. The type of mutual fund that investors are choosing has also changed. In 1982, money market accounts were the clear favorite, with 74% of investors choosing them over stock funds and bond funds. By 1987, the mix had changed quite a bit, and investors were fairly evenly spread between the three main categories. Right now, money market funds have gained more ground, accounting for 42.5% of all mutual funds, while stock funds represent less than a quarter of the market. In order to find out how well mutual funds have performed over the past 15 years, we compared figures from Lipper Analytical Services average of all equity funds with the Standard & Poor's 500 index adjusted for reinvested dividends. The mutual fund average outperformed it only for the 15-year span. Has investing in mutuals become more complicated than the stock market itself? How well do they protect the small investor? And what type of funds are the best investments for the years ahead? For some thoughts on that, let's go over now and meet tonight's special guest, Gerald W. Perritt. Jerry, welcome.
Thank you,
Nice
Carter.
to see you.
Nice
Have
to
a
see you.
seat.
Thank you.
Right. Excuse me. Our guest tonight, Gerald Perritt, began his career as a college professor of finance, but after 9 years, he gave that up to devote most of his time to launching what are now two successful newsletters, Investment Horizons and the Mutual Fund Newsletter, as well as writing several books on investing. His latest enterprise is managing his own mutual fund, which specializes in small company stocks. Jerry, should investors buy mutual funds rather than individual stocks and bonds?
Well, it's kind of a mixed bag, Carter. One of the basic things that we all know in investing is that you can reduce risk significantly by diversifying. It's very important that you do so. If you have small amounts of money, mutual funds are definitely for you. If you have the time to study the markets, and if you have a significant amount of money that you can diversify, then I think direct stock investing is more important and better for you than mutual funds.
Well, all right, we've already seen that there are more mutual funds than there are stocks on the New York Stock Exchange. How can an investor choose from among them?
Well, these days it's getting to be much more difficult. But one of the things that you are doing when you buy a mutual fund or when you invest in a mutual fund is you're hiring a money manager. I think what I would do is I'd like to ask the questions of the mutual fund manager that I would of someone who's going to be managing my money directly. You get the answers to those questions by studying the annual reports, by studying the statement of additional information and the fund's prospectus. That's the place where you do start. There are some characteristics of funds that tend to be better performing funds. They tend to be smaller funds. They tend to be funds that turn over their portfolios less frequently. And they tend to be funds that have relatively low expenses associated with them, both in terms of management expenses, transactions costs, and sales fees.
Well, tell me about those expenses and what are the average and how should an investor look at them?
Well, a lot of investors don't really pay a lot of attention to expenses when they deal with mutual funds, and that's a big mistake. Over the last 50 years, for example, common stocks have returned somewhere between 10 and 11% compounded annually. If you have a mutual fund that has a 3 or 4% front-end load,
front-end load meaning the
sales
cost of
charge,
getting in the first place.
That's correct. If the management fee is 1%, if incidental expenses are 1%, if there's an ongoing distribution fee, like a 12B1 fee that might be a half or 1%.
12B1 meaning?
Meaning that it's a fee that shareholders of the fund bear to pay for advertising and other marketing expenses of the fund.
Right.
If those fees add up to 3 or 4%, that's 30 to 40% of the stock market's average return that's being taken out of your fund year after year. Eventually, that takes its toll.
Okay. What role does performance analysis play in choosing a mutual fund?
Well, that's a very interesting question. I think most people who select mutual funds look at performance as their #1 variable. We look at performance as one of our last variables. We look at some of the other things that I mentioned in terms of fund size, in terms of portfolio turnover. But once we've narrowed down our funds to a handful that we think we might be interested in or recommending to our subscribers, then we go and look at return of those particular funds, compare them with like returns from other funds who are trying to do the same thing.
Part of the problem with analyzing performance is that you're always looking at past performance, and the past is not necessarily prologue to the future. Is that right?
That's absolutely correct. In fact, the research in mutual fund returns has indicated that correlation of returns from one period to the next, that is, the relationship, how do they move together, is very, very low. So one of the worst things that you can do is to look at past performance solely in trying to select a mutual fund and predict its future performance.
I remember a study by institutional investors several years ago that proved that if you bought the worst performing fund on the first of every year, you'd be better off than you would be if you bought the best performing
That's
fund.
for sure.
But nobody's going to do that.
No, they're not. At times we have.
Okay.
We've invested in some funds, or we've recommended some funds for subscribers that have been very poor performers. You ought to see the letters that I get from subscribers wanting to know if I've lost my mind.
All right, now funds have many different characteristics, and they're invested differently and so on. Bonds, stocks, money market funds, etc. Tell me, first of all, about money market funds. Is there a way to choose a money market fund in which to invest?
Well, what I've been recommending over the years, basically, for individuals is find a money market fund that gives you convenience. One is pretty much like another. The yields are relatively stratified in a narrow band. And so you look for one that gives you the kind of services that you're interested in, and maybe is coupled with some of the other funds that you've invested in as well.
All right, how about bond funds?
Traditionally, bonds have been bad investments for investors. You know, own the thing that...
Because they don't keep up with inflation, is that what you're saying?
That's been the big problem. I think over the last half century, long-term bonds have produced about 2.5% rate of return greater than inflation. That doesn't account for the taxes that are taken out from your bond investments as well. So long-term performance favors stocks over bonds.
All right. Equity funds, stock equity funds, how would you go about choosing which ones of them to own?
Well, first of all, you have to ask yourself, if you were going to manage your money yourself, how would you manage it? Would you be a market timer? Would you be a long-term investor? Would you invest in blue chips? Would you invest in small equity cap stocks? Once you've answered that, that will narrow down the universe significantly. We then go through a series of screens. We look at size, preferring funds that have less than $300 million under management. We look at funds that have relatively low portfolio turnovers, those less than 50% of portfolio turnover rates. And when we aggregate all the expenses associated with running a fund, we like those to be less than 2.5%.
Now, some of the larger funds are very popular. Why do you emphasize smaller funds?
Well, basically, that smaller funds have more flexibility. Take a fund that might have $5 billion under management. And let's suppose the fund manager decides that the economy is starting to wind down and that maybe being in money markets or perhaps bonds is better than being in stocks. That's a lot of money to unload in a relatively short period of time. They can't do it. The smaller funds do have that flexibility.
All right. Now, Jerry, tell me some funds that you do like at the present time.
Well, we're very conservative at this point in time. We're looking at the economy in 1990. We don't particularly like what we see, so we've taken a very conservative approach. We like yield-oriented funds. We have been recommending utility funds, Fidelity, Select Utilities, Financial Strategic Utilities, T. Rowe Price Equity Income Fund, a Fidelity Balance Fund. In the small equity cap area, which we do like, we think that small firms can grow through this recession. Basically, there are two, the Babson Enterprise Fund and the Calvert Aerial Capital Management Fund.
Okay, Jerry, our panelists have a mutual interest in getting a fund of information from you. Let me start with Marty Zweig.
Jerry, in April, which the numbers came out for April the other day for the mutual fund industry, there were net sales of equity funds of something like $900 million. That is, money flowed into the funds. Do you think this is the start of a trend that the public may be coming back, or is it just a random jiggle?
No, I think the public is going to be coming back into this market more and more. Stock market, the average investor went on strike after the October 1987 crash. But I think that's a bad sign. Because I think what we're doing is seeing the top of the market, and we're seeing people come in at exactly the wrong time.
Okay.
Jerry, you've mentioned that you're cautious about the market. I know in your letters you give advice to your readers as to where they should be invested according to your market scenario. What are the things that you look at to determine your market opinion?
Well, basically, we do take a fundamental approach. There are two things that we do look at. We do look at the future for the economy, and we do make some forecasts. But we also look at alternative rates of return. When we start to see money funds yielding better than 9%, when we see intermediate-term government bonds yielding better than 9%, we decide to allocate money going where the yields are. So that's caused us at this point in time to be about 1/3 stocks, 1/3 intermediate-term bonds, and 1/3 money funds.
Jerry, given the whole universe of funds that you know about, you've chosen to start up a small stock fund. My question is, why small stocks, and what companies do you like?
Well, first of all, we have been, in our newsletter, Investment Horizons, we've been following small firm stocks for a number of years. So we've used that basically as a showcase. It's one of the things that I think that I know reasonably well in this market. That's why it's that kind of a fund. In terms of companies that we like now, three companies come to mind. Anthony Industries. I'll give you one in each trading location. Anthony Industries on the New York Stock Exchange in the leisure products business. Superior Surgical, which is manufacturing garments in the healthcare and hospital field area on the American Stock Exchange. Well, I'll just give you two then.
Okay.
And even Gerald Perritt, who is right a lot of the time, is not always right, so we better put that caveat in there as far as our viewers are concerned. Let me ask you, Jerry, a lot of people buy mutual funds literally because they're lazy. They want somebody else to manage their money. They don't want to have to think about it. They have faith in the managers of those funds. Would you have any advice to what I'm referring to, the lazy investor who wants to buy mutual fund shares and forget it?
Well, Carter, I think you and I both know that the lazy investor is usually in trouble. I think that applies to mutual funds as well as investing in stocks. If you're that lazy, head for an insured bank account, I think would be my suggestion for the real lazy investor.
All right, but is there a way for them to diversify among funds at least?
Oh, absolutely. One of the things one of the buzzwords on Wall Street these days is asset allocation. And it makes a lot of sense to take your money and divide it and put it into several different pots. The term that I used before is a correlation of returns, which means, in a sense, when the return from one is falling, the return from the other might be rising. By putting your money, let's say, in 7 different areas, blue chip stocks, small firm stocks, international bonds, money funds, domestic bonds, and gold. And if you were to divide that pie into 7 parts and invest your money there, you find that your return long-term will equal about the S&P 500 total return with a variability in that portfolio of about 1/3 the S&P. Far less risk, about equivalent rate of return.
Some people use families of funds so that they can switch from one fund to another if they want. Does that make sense?
Well, again, to some extent, but I think that's a cop-out for lazy investors. What we find is that when you look at families of funds, there's 1 or 2 funds that family has specialized in and 1 or 2 things that they do very, very well. We don't really recommend that investors stay with one particular fund, but let them shop around from family to family.
Jerry, I shouldn't admit it, but I have a grandchild or two or three, and if I wanted to help to fund on a dollar averaging basis over a long period of time, things like college education for the children and so on, how would you advise my doing that through the mutual fund area?
Well, basically, one of the things that most funds have is an automatic investment plan.
Yes.
You can invest dollars every month or every quarter, sometimes as little as $50 a quarter. This makes a heck of a lot of sense. You do gain some benefits of price averaging over time, and anything that gets people to commit more and more dollars over time to equities is a real positive thing as far as building wealth is concerned.
We have just a couple of seconds to go. Jerry, give me a quick answer. Gold. Would you advise people to invest in the gold fund?
No, not at this particular point in time. I think inflation is waning at this point, and we're going to see interest rates coming down. That doesn't bode too well for the gold market.
Thank you. I'm going to have to interrupt you at that. I hate to, but our time is up. I want to thank our guest, Gerald Perritt, and our panelists for joining us tonight, and thank you for being with us tonight. I hope you'll be back next week when Louis Rukeyser will be back. His guest will be David Reuter, the chairman of the Securities and Exchange Commission. Lou will be revealing the results of an exclusive poll on ethics in Wall Street. It would be a crime to miss it. This has been Wall Street Week with Louis Rukeyser. I'm Carter Randall. Good night.
Wall Street Week with Louis Rukeyser has been brought to you by public television stations and by Prudential Bates Securities, the investment firm with rock-solid resources and market-wise thinking in the business of making money. For a printed transcript of this program, send $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. That's $5 to Transcripts, Wall Street Week with Louis Rukeyser, Owings Mills, Maryland, 21117. Wall Street Week with Louis Rukeyser transcripts are also available to subscribers of the Dow Jones News Retrieval Service. Wall Street Week with Louis Rukeyser is produced by Maryland Public Television, which is solely responsible for its content.
Local broadcast of Wall Street Week with Louis Rukeyser is funded by Tyco Laboratories Incorporated, a nationwide diversified manufacturing company. First NH Investment Services, a member of First NH Banks, a dedicated money and investment manager providing individuals and corporations in New England with a full range of investment services. And the New Hampshire Insurance Company and your local independent insurance agent. The New Hampshire, your connection to the world. The New Hampshire Stock Report is made possible by Dean Witter of Portsmouth, now also at 1001 Elm Street, Manchester, a member of the Sears Financial Network.